lower tax rate. However, with the key employees, since they typically aren't making as much money as the owners, the arbitrage for the key employees tends to be smaller. So, even though these are golden handcuffs, they can defer some taxes, maybe get out at a slightly lower rate. I have not seen as much interest in that. I think Howard and I, for the cases we have done in our careers, I would say probably less than 5% of the captives have any type of key employee owning it. Could be a growth area, but again, that's just not been a big focus. I would say after the shareholders, really the prominent way to own these is tying into the next generation owning the captive. And that really adds an additional layer of savings, because if the next generation or the trust, family limited partnership, however you decide to own this captive, if that is the owner of the captive at the very beginning, then other than the capitalization that a domicile would require, for example, if you're doing a Delaware series captive, the capitalization may be as low as $100,000. If you're doing a standalone in most other domiciles, that could be $250,000. Other than that first $100,000 to $250,000 of capitalization, that would have to be a gift to the next generation. That premium that is paid to the captive each and every year could go to that next generation without any gift or estate tax. So now we're not just talking about an arbitrage deferral tool, but we may even be able to add in some of that additional estate tax savings down the road.
That's a point worth emphasizing, because with income tax, with a captive, with an 831B, you are deferring ordinary income into a lower tax bracket, taking out long-term capital gains. With regard to estate and gift tax, if the captive is owned by a dynasty trust, such as Delaware Legacy Trust, or some type of family limited partnership, of which the beneficiaries are children or grandchildren, then when that operating company made that premium payment and got those funds out of the estate of the owners of the operating company and into the captive, which is owned by a trust, as Brian said, you don't trigger estate tax, gift tax, or you don't trigger a generation skipping tax. So with regard to the estate tax, you eliminate the tax. You don't defer it into a lower tax bracket. That is huge. That's a very big deal. I mean, the effect of this, you run this out for 5 or 10 years. For example, Alliance Bernstein manages a lot of the monies that we former captives, because they're very familiar with it. And you run these pro formas out, and you defer income tax into a lower tax bracket, and you also eliminate the estate tax on these premium payments. Well, the numbers jump off the page, obviously. Brian, go ahead, please.
And one interesting development I've seen, there's a firm out of Atlanta that I've seen do this, and it's for all of their clients. I've done it a few times, but there's also the issue of state income tax. Now, I have seen several folks set up Florida trust or a trust in a state that has no state income tax to own the captive. And it could be for the beneficiary of the shareholders or the family members. In doing so, when you extract the proceeds out of the captive, then that trust will just pay the federal tax. So for residents in higher tax states, such as California or New York, it may be possible to defer, maybe even eliminate some state-level taxation. Again, that's something that the captive manager, we don't do at Atlas. We would get the attorneys involved, but that has been something I've seen a lot more interest in with some of the recent